Well, hello, everybody. Happy Sunday night. How is everybody doing out there? This show is going to be hot tonight. It is going to be a good show. I have my hat on backwards, and that's always the sign that we're going to have several rants on the way. I'm in a good mood. We're going to have, like I said, we're going to have a great show. Seriously, we are. I kind of fell onto this idea at the last second today, but the more I think about it, we're going to do this every week, every single week. All right, let's check the market while we're waiting for folks to get here. I tried to make this as early as possible, but given the new format, I was trying to have it on a half hour ago, but I had to do all kinds of stuff because of the new format. So, but it's going to be worth it. This is going to be some excellent content. You guys are going to love it. I'll give your money back. If you guys don't love it, you can have your money back. All right. Speaking of money, check this out. This isn't really money. This is just about pride. But look, I finally reversed my subscriber count fall. It dropped all the way from 5,000 to it dropped 80. I've never lost 80 subscribers in my life. But anyway, I've been doing a lot. The channel's been doing a lot better. Look, in the last 365, nothing but up. There was one time I lost like 14. One time right here, I lost like 14. That's the most I've ever lost. Then I get over 5,000, get to 5,007, and then just the cancellations start coming in. Boom, all the way down to 49.20, but I'm back. I'm going to pass 5,000 again for a second time. So anyway, thanks for all your support. A lot of you guys have given me advice and have helped me with content ideas and other stuff. So it's going much better, and I appreciate it. I finally started to make some good original content. I really liked my video the other day. I don't think anyone else did, but I really liked it. I did get 3 subscribers from it, and I got, but anyway. All right. Let's see what the heck's going on here. Let's get the market up here. MES, gosh darn, let me get this darn stuff off the screen. Well, look at that. Just bouncing. We're up into Friday's trading range. That's a good sign. Anything above 66.40 is in Friday's trading range. We were outside of it for a little bit, but it looked like so far it's been a bear trap. People get bared up, and boom, it ran right back up in here. But of course, I'd be watching this line right here, amongst other things. But if we get accepted under there, we're probably going to challenge last Sunday's low. So, but if we can stay above there, maybe we'll go, trade up in here to this 6,700 node, and maybe even mount a rally for this little high from Thursday night or Friday morning, I guess, the little bull trap rejection high at 67.36. We take that back, then maybe we can eventually get 67.90. I don't see it happening. I'm bearish as can be right now, but I'm wrong. I'm wrong about half the time. So hopefully this is one of those halves I'm wrong, right? I may be right like 51% of the time or something. What's up, William? Thanks for being here. Thank you so much for being here. Hey, remember, everyone, this is not financial advice. Consult a professional financial advisor. Like I always say, you can only work to a certain age, and then the money that you've saved up and invested has to last you the rest of your life. So it's serious business. You don't want to go out and listen to something you hear on the internet and do something crazy. A financial planner is worth its weight in gold, a good one. All right, so let's see what else is going on. So that's S&P. Let's check NASDAQ. NASDAQ, same deal, up about half a point in Friday's range. We'll take it. We'll take it, I should say. Let's check Bitcoin. Yes, heck yes. Well, let's just say it's down. It don't look like it's down, but I guess it's down from the Sunday open whenever they start their week, which is in any event. But it's been leading on the way up. It's been much stronger than the market lately, which is good to see. Still are far from being out of the woods in Bitcoin, but I wonder how far we are under the 200-day. Let's just go check it out really quick in Bitcoin. Let's just go check it out. 50, and we want the 200. That's EMA. Well, whatever. We'll do SMA. Oh, I like EMA better because we're closer on EMA. In any event, we're a long way. EMA, SMA, whatever MA, MMA. It doesn't matter if it's MMA, SMA, or EMA. We're a long way away. I think EMA was about at 90. SMA is about at 93.8. So you got a ways to go. And even that big rally where we rallied hard, we didn't even sniff the 200-day. The 200-day was 105, and we stopped at 98. Just classic bear market behavior. Massive face ripping rallies and then go take out new low. Face ripping rally, go make a new low. We need to reverse this trend, get back above the 200-day moving average and hopefully get the 200-day moving average sloping up again at some point. But we're a long way from that, which is part of the reason for my bearish thesis on the market. Because so much stuff in the market anymore is indirectly related to this kind of stuff. All right, so let's check gold and silver. All right, good job, gold. Now that's a daily chart of gold. Now gold's coming down here and challenging the 50. I mean, but the last time it hit the 50 was February 3rd. It was supportive. People bought it. You could see the 50's been very supportive for a while. The last time we were under the 50 and the 200-day was that September and October of 2023 pullback. And I remember that was not fun. But then since then, gold has been above the 50 and 200 the whole time, most of the time above the 50. And if it pull back to the 50, it looked like good support. Let's see how similar silver is or not. Let's see here. And I guess we'll look at oil and then we'll get on to the daily factor, the hottest show on the internet. Someday the daily factor is going to have like 500,000 subscribers and you guys are going to say you were in the first 5,000. All right. So, silver, just in relation to the moving averages, has not been as strong as gold. Now, lately it has. But silver got under the 200-day during the April pullback, which was a nasty pullback for stocks. But ever since that April pullback, silver's been above the 200. The 200's been sloping up, and the 50's been very supportive for silver. All the hallmarks of a bull market. All the hallmarks of a bull market. All right. What's the show about? I've already forgot. I've already lost interest. I'm getting tired. Let's check out crude. I really don't have any. Gosh darn it. Are you serious? Look at that. I haven't looked at a daily chart of crude in a while. I just look at 30-minute charts, but that's something else. And crude has just been the definition of a bear market, trading under a downward sloping 200-day. We did have some sharp rallies, where we'll run up from 65 to 78 in a week or something, or 65 to 80 in a week or something, and then go and make a new low, run up, make a new low. Classic bear market behavior. We did kind of fake above the 200 a couple of times, but they were huge traps. So huge bull traps. All right. Well, the new show. So let's talk the new show. Let's see, what are we going to do here? So let's review. So I have a metric called the max factor, and I do a daily show every week. And this week, USOY1. Here's the top 40 again, real quick. It went TSMY, GLDI, RNTY, ASGI, iGold, AEF, SOXY, YGold, MLPD, GNT, SLJI, BUI, STK, IDE, BCAP, SCHD, UTG, BCX, IAUI, KSILV, HTD, XLUI, FXOY, DOGG, EDF, CRSH, HDLB, NDIV, YQQQ. I got to love that one being on there. TYG, MRNY, MDST, KGold, WEEI, SRB, XOMO, XLEI, USOI or USOY or USOI, not to be confused with, well, not to be confused with Sarco at number 2, and not to be confused with USOY from Defiance at number 1. So that's the top 40 list. And lots of times I do a rundown where I show who did the best in the top 40 on average return and average yield. And you can kind of see how many, State Street had 3 funds in there, or it says 3 here, but there's 4 here. Anyway, that's another story. But what I've done is I've gone a step further. Well, for one thing, I've made a complete database. I have a complete database with every metric. So we can look at any ETF you want to talk about. If you have a question, if you want to say, why didn't Palantir get on there? What's the matter with XBTY? How bad's it doing? Well, not great. We can look at that. But what I did that I'm particularly proud of is this. I made an issuer performance report for the entire industry. Or the entire max factor. So I have about 253 companies. There it is right there. I always say 280, but I had some duplicates. And there's I do have 280, but some of them aren't 3 months old yet. So some of them haven't made the database yet. But out of 253 companies, the 40 I just read you would be the top, the top 20% basically. So, out of every, 4 companies out of every 5 didn't make that. They're on the rest of the list. But what I did with the issuer performance report is I ranked everything, and I even took an average. So we have a industry-wide average of average yield, average NAV return, average 1-year total return, average short-term max factor, average stable dex, and average Moxie. So I thought this would be interesting to kind of go over, and so I'll do a little presentation on it right here. I guess I'll talk for a little bit, but then ask questions, and we can look at whatever you guys want. I brought all the receipts tonight, so we can look at whatever you want. We can talk about my video from Friday. We can talk about all kinds of stuff. So, all right, so. Ranking it by ranking it by total points. I made a point system. I gave, it doesn't matter, but I gave a certain amount of points for, being in the top 5%. And then a certain amount of points for being in 5 to 10%. The top from 5 to 10, then 10 to 15, 15 to 20. Anyway, and if you're in the bottom half, you don't get any points. You shouldn't get any points for being a loser. But if you're in the top half, you get points. And the higher you are in the top half, the more points you get. Very basic linear type scoring system. It was just like 10 points for 0 to 5, 9 points for 5 to 10, 8 points for 10 to 15. You guys get it. Just a standard. And anyway, and then no points when you're under 50%. So this just a little scoring system. So the total points for all, that doesn't mean anything, but for YieldMax ended up with 87 points. Now, it is true they have 62 ETFs. Let me make this bigger so you guys can see it. And now, it is true that they have 62 ETFs. We'll get to that in a second. But on second most points, it does mean YieldMax did have a lot of people that were in the top half of the list have that many points. State Street, they have 12 ETFs in here. And their company-wide max factor is higher than YieldMax's. Heck yeah. Good job, State Street. And their total points is 37. All right. Oh, no, I'm sorry. Okay, so that's what it did. Okay. YieldMax has 87 points, but they have 62 companies. So you divide the points by the companies. This isn't the average max factor, but I made a new index called the company max factor, which is just the points divided by the number of the companies. YieldMax shouldn't win just because they release more, just because they have more ETFs out there. I want an apples to apples basis on everything. That's, I love fair comparisons and things where you can measure stuff. And so anyway, but they do. So in other words, their average score is 1.4. So having the 62 companies hurt him. If they would have made 87 points, but had, 20 companies, then they probably would be ranked ahead of State Street. But in any event, State Street looks good. 37 companies. Well, here's another way to look at it. The average YieldMax ETF was ranked 162nd. The average State Street was ranked 93rd. But anyway, back to the points. Just on points, State Street did do well. There's no doubt. Amplify did well on points. They have 11 funds. They did great on points. And really, if you factor in for how many companies they have, they're better. They did better than State Street and YieldMax. And now we have UBS. Now, UBS only has 4 companies, but it had 29 points. So they're doing better than any of the ones we mentioned so far. At least this week they were. BlackRock has 5 companies, 29 total points. So they didn't do quite as well as UBS. Then we have Aberdeen hit the board, had some stuff there. Then we had Curve. Now, Curve only had 26 points, but they have 7 companies on the board. Still comes out to respectable 3.7. But anyway, you guys get the idea. So let's kind of see some of these guys only have 1 point. And if they were in the top 5%, like NXG Investment Management has the Cushing Midstream deal, whatever that's called, the Cushing Midstream Energy Infrastructure, high yield, whatever. And that was in the top 5%. So they got 10 points divided by 1 company's 10. So, Tortoise also has a 10 and that's it. But anyway, okay, you guys kind of get the gist of this. Let's go to some of the more popular companies. Where's Neos? Well, anyway, let's just rank it. Let's rank it by company max factor. Okay, so Westwood, and they have 2 companies, but they're both in the top 5. I mean, good job. NXG, good job. Tortoise, good job. John Hancock, good job. Reeves, good job. All right, great job on all the guys that have one company. At least they're one company ranked highly. And Charles Schwab has 9. That's SCHD. So that means SCHD was in the 2nd percentile from 5 to 10, or 5.01 to 10. And then the next one was 10.01 to 15. Anyway, you guys get the idea. Columbia Threadneedle. And then anyway, of the ones that have multiple companies, the ones that have multiples, like at least 10, the highest ranked one is Amplify. The second highest ranked one is State Street. The third highest ranked one is YieldMax. The fourth highest ranked one from the bigger companies is Round Hill. Rex has 9. That's close enough. Of the ones that have 9 or more, Granite Shares has 10, and they didn't hit the board. They had, they're struggling lately. Leverage works both ways. I mean, they'll be back hopefully. Now, what I'm wondering is, where's Neos? Oh, there's Neos. Okay. Neos has 8 companies. We want Neos to be in the survey. So of the funds that have more than 8 companies is the cutoff. So these are the bigger issuers. Of the bigger issuers, you have, BlackRock did a really good job, but come on, 5 companies. I mean, of the bigger issuers, we're going to have to throw Curve into. Okay. So you have to have 7 or more. Of the people that have multiple ETFs, Curve is number 1. Amplify is number 2 this week. Neos is number 3. State Street's number 4. YieldMax is number 5. Round Hill is number 6. Oh, did I say Rex? Yeah, YieldMax is number 5. Rex, because 9 counts, has to just be above 7. Rex is number 6. Round Hill's number 7. Then we have Granite down here, number 8. And that's it. So that's the max factor. So I need to make a separate sheet so we can follow this. But so who did I say was number 1 again of the big companies? Was it Curve? Because I kept lowering the number. I mean, I wanted to be able to compare Curve and Neos. I mean, they're definitely, but BlackRock at 5, that's just not enough. The cutoff 7. So yeah, Curve 1. Curve's number 1. Amplify's number 2. State Street or Neos number 3. State Street number 4. Oh yeah, Simplify comes in with 7. at number 5. That knocks YieldMax down to 6, and then we have Round Hill, and then we have Granite. All right. So, but we can look at anything. So let's look at the company-wide average. Like, let's just, well, average is right there. So for all these ones, every one that we follow, the average one of them pays a 44% yield. And the average NAV return is actually negative. And I wouldn't doubt that because these things pay the yield out of the NAV, and they have on average a 44% yield, which means what, 4% a month's coming out. So for something to have positive NAV return, a month is a quarter's 3 months. So 4, 8, 12, it means only the companies that have 12 or about more percent NAV return would have, would have positive total return is what that means. Well, in any event, but this is encouraging. Of all the companies on here, the average 1-year total return is 11.81. So it's not like these are a Ponzi scheme, just like YieldMax isn't. It's just like the whole industry isn't. If like the whole industry averaged 4, on a 1-year total return, I'd agree. I'd go, yeah, these things are. I mean, the data would prove it. But YieldMax actually averaged 12 or something on their total return since inception. Now, here's the catch on this one, though. This is just the past year. And a lot of YieldMax's funds, especially some of the better ones, got a lot of their alpha not in the last year. You know what I'm saying? So because Misty and NVDY got off to a really hot start, and some other ones too. But the last year has not been as good for YieldMax as the since inception. But anyway, so 11, 12%, that's a market performer. So if you have 253 of these high yield funds, they're also closed-end funds. Some of them aren't that risky, and some of them are MST, or as risky as you could imagine. So, but if you just bought one of all of these, you'd be up about 11%. So people might still say, well, yeah, these are ripoffs because look, you aren't even outperforming the market. And that's true. And that's because there's no free money. I mean, it's really hard to outperform the market. When you get a large group of anything, it reverts to the mean. That's what the law of large numbers do. But I thought that was encouraging that the average fund earns a, I really thought it was encouraging. I didn't really expect the average YieldMax fund to be a market performer. And over the past year, the average out of these 253, I'm going to say, are market performers. But once they aren't get rich quick schemes, doesn't mean that people can't do well in them. There's some of them that do wonderful, but there's some of them that do terrible. And a lot of people have got wrecked in these. So, I mean, just be careful. The average stable dex is a 68. So the market's 100 on stability. So this means the average one of these things is only about 2/3 as stable as the market. Now, some of these, as you know, are real stable, but just on average, because we also have ones in here like MST and the ones that use leverage and all that kind of stuff. And also, this is just 1 week. As soon as we get back in a bull market, Granite and Round Hill are going to start doing a lot better. Both of them use leverage. So I even if you're a Round Hill or Granite fan, I wouldn't be too discouraged. This is just 1 week. It's risk assets haven't been doing well the past month, the past week. Granite and Round Hill have a bunch of risk assets based funds, and they have a little bit of leverage. So, I wouldn't even be surprised in the bull market to see Round Hill be at the top of this list. Round Hill does a good job, but they're, they really do. I like XDT. I like QDT. I think you guys do as well. In any event, all right. Well, let's see what else we have to talk about. So I just think averages are cool. So you know what you're up against. But here's the downside. Okay. So the average 1-year total returns is 11%. That's pretty good. But here's another way to look at it. On 1 year, yeah, these funds are a market performer. But if you look at the same funds this quarter, they're down 9%. It's been a rough quarter. Over the past year, they've been doing all right. And where'd that come from? Last summer, a lot of these printed money. Like I always say, even ULTY was printed money last summer. If you bought it in April and sold it in September and October, like I did, you made out pretty well. But it's not just them. Look at like blocks. Look at BT. No, look at anything last summer, because Bitcoin, gold, and the market were rallying at the same time. So anyway, what I would imagine is the NAV return last summer was probably 15 or 20, something like that. And now the NAV return's 9, but we're still averaging 11 for the year. So I'm going to chart this. We're going to keep a track of this every tick. I mean, this really is interesting to me, is following the individual companies. Now we'll get back to the individual company show tomorrow night. Tomorrow's Maximalist Monday, and we'll put all the, we'll put BTCI, we'll put blocks, we'll put up all the LFGY, all that kind of stuff, and we'll get back to our normal program. But I think this will be cool to do once a week. I'm really interested in the average. I mean, the average fascinates me. But anyway, we can chart the ratio, or there's all kinds of stuff I'm going to start charting. We're just going to build a data set. The average short-term max factor is negative, and that doesn't surprise me because the average quarterly NAV return is negative. If you have negative NAV return, you're going to have a negative max factor. That's all there is to it. You cannot have erosion and be in the max factor. It's just not allowed. Well, not be towards the top of the list. You can still be in it, but but you're going to be behind the people that do have positive NAV performance. And it's not only that, and then it also considers the yield, the return, the momentum of the underlying, and the stable DEX. But just on a company-wide thing, you can look here and see like which company is the most dangerous. You'd probably say YieldMax, but I'd probably say Granite. But let's rank it by stable DEX. Okay, the most stable company only has one fund. The most stable company that has 7 or more, that's what our cutoff is for big companies, is State Street. And it has an average stable DEX that's 18% more stable than the broad market. So if stability is your thing, you like high yield funds, but you don't like all the risk, all the reverse splits, all that kind of stuff, I don't think you're going to have as big of a problem in State Street. Not that there couldn't be a problem still, but I mean, that just mathematically, at least lately, that's the safest big company. The second safest big company will not surprise anybody. That's Neos. Neos does a great job with the 112 there on stability. You got to love that. The average Neos fund or high yield fund, they have a lot more funds than 8, but I just have the ones on here that are high yield. The only thing that's low yield on here is one Charles Schwab, the SCHD. Everything else is at least 5%. And most of them are 7, 10, 12, 15%, something like that. All right. Out of the next biggest company, out of the big companies, the next most stable is Simplify. All right. And Simplify is an average stable DEX of 90, meaning they're 90% as stable as the broad market. Then we have, after that on stability, we have Amplify down here with the 63 stable DEX. What do we have here? Then we have YieldMax with the 45. So their average ETF is about almost half as stable as the broad market. Round Hill's in the same boat. They're about a 44. They are about a 44. And then Granite Shares is a 38. And I don't really think that surprises anybody. And this does surprise me. And I'm gonna call BS on this. I want to rerun the numbers on this. This Rex is they must have one company that's super unstable that's bringing their score down. Maybe ULTI is probably what it is. That's just super duper unstable. And they have the single stock MS2, that's pretty CO2. So I guess anyway, now I've been saying I'm going to do a company-wide show where we're going to take the since inception, and I'm still going to do that. And this doesn't substitute for that, but this is a live that we can update this every week. When I do the since inception, I can just do that once. I mean, I do that because it goes back more than a year, but this, you have a new year every week. You have another new year because it goes from, 52 weeks ago to now. So I think this will really help us to really get a handle on which one of these are BS, which one of these are taking the most risk and not even giving you the proper amount of money back, considering the risk they take. And which one of these are, doing the best job balancing risk and reward? So, okay, so that's average stable dex. Now, Moxie's the long-term max factor. So let's just go look. I mean, the big company with the most Moxie is Amplify. Good job, Amplify. Then after that, it's State Street. Good job. And then we have Round Hill. Good job, Round Hill. Round Hill does say, even though it's been a rough quarter for Round Hill, they do have some good, long hill results. Look, Round Hill's 1 year total return is 22%. That's not too bad at all. And that shows up in the Moxie. The Moxie is your total return over the past year in terms of your volatility, with volatility considered, volatility adjusted total return. Great job, Round Hill. Anyway, then we have Granite, YieldMax, and the rest. All right, so that's average stable dex, average short-term max factor. Let's see. Average quarterly NAV return. Of course, these are all just ones with one company, but of the ones that are not one company, it's Curve, number one, with an average 1 year total return of 26%. Good job, Curve. Good job. Number two is State Street. Number three is Neos. All right, so that's average quarterly NAV return, average yield. I bet this one goes to Granite. Okay, of the big companies, it's Granite, Round Hill. We should include Defiance in the big companies really too, but I mean, we're going to have to lower it to 6, I guess, to get Defiance in. Anyway, Granite, Round Hill, Defiance, YieldMax, Rex, and it goes down from there. Of course, a high yield is usually not a good sign. So this is something that's good. You want a high yield, but it also, you notice it also picked the companies that are having some of the, less good results lately anyway. Then we can look at average rank. I mean, average rank of the big companies is number one is State Street. Number two is Amplify. Number three is Simplify. Number four is Defiance. Number 5 is YieldMax. Number 6 is Rex. Number 7 is Round Hill. And number 8 is Granite Shares. Next time I'll have AI break out the big companies separate so I don't have to scroll through it. And I'm going to set the cutoff at probably 6 because I think I want to compare Defiance in with these two. So, but also these companies are all releasing new funds all the time. So as these companies release more funds, I think this will be more statistically significant. Really, to look at 5 or 6 companies probably isn't that statistically significant. So just like everything else, take all this with a grain, with this huge grain of salt, just like anything. Remember, not financial advice, consult a professional advisor. I'm going to leave that up for just a second to remind you guys. All right. So, what do you guys want to talk about? Do you have any questions about the YieldMax video, or you want to look at some individual companies? You want to see which company is the worst company out there? Let's go look. I hate to be negative. Oh no, it's COYY from Granite Shares. Oh gosh, the worst high yield fund there is right now. Super volatile, super bad NAV return. And the yield, well, the yield's fine, but anyway, I mean, all of these down here at the bottom are, have some combination of terrible NAV return and super volatility. We also have HOW, MAAY, MST, RDYY, AIYY, RBLY, Dre, Carvani, Hui, TSYY, OCCI. All the dogs are down here. Anyway, you guys get the idea. I don't like dwelling on the negative ones because there's nothing wrong with CO2 or, well, I don't know about COYY. There's nothing wrong with HOOW. I mean, it's a play on Hood, and it was doing great. People were breaking on this thing. It's not for a down market. Leverage works both ways, but I'm saying I wouldn't be surprised in the future to see this back towards the top again. I mean, Granite Shares, I don't know about that one. But Now, AIYY is legit no good. That one is extremely, extremely disappointing to me. Yeah, I don't even want to talk about that one. But anyway, so if you guys want to look at any specific companies out of there, you want me to check out anything else, we can look at the oldest companies. We can look at the best NAV return, worst NAV return, the most volatile. Anyway, short-term max factor and the stable dex. And next week, I'm also going to actually have a long-term max factor show also, where I don't know if I do a reveal, but I'll do something separate, because not everyone likes these little short-term ones, K-Gold, and not everyone wants to switch in and out as actively as this. The long-term max factor is the Moxie, but I'll make a separate. I'm going to start calling that the long-term max factor instead of the Moxie. It's a good metric. It's better than what I was using for the long-term max factor. So next week, that will be able to be judged too. For some reason, he didn't put Moxie on here. I told him to, but whatever. This is much improved, I think. All right. So I'd love to answer questions or talk about anything you guys want to talk about. We got Zinful Rocks. Now, you're in our Discord right now. Did you join our Discord last night, Zinful? I think I saw you in there. I appreciate you being in there. We had a real good time at Discord tonight. A few of us were in there. The same guys that are usually in here, but they're all in bed right now. But it was Mark and it was Mayor. It's like 2:00 in the morning in Tel Aviv, where Mayor lives. It was Mark, Mayor, Brad, me. I guess that's all. But anyway, we had a really nice talk. Yeah, X Funds is on the list. They just didn't have enough to really look at. Well, and their flagship funds haven't been doing great lately. So they'll be back. David Nicholas can figure it out. I mean, his flagship fund is a Bitcoin fund. Had he opened his fund Golden, GLDN, and SLVX, which he just opened, but had he opened those when he opened blocks, it's a part of it is just being in the right place at the right time. I mean, I don't care how good of a fund you have, how good of a strategy you have, lightning spread, you're going to manage, you're going to hedge, you got callers here, you're going to be non-diversified, whatever. I don't care how good it is. If the underlying assets that you're selling premium on are in a bear market, it's going to be tough sledding for you. But yeah, so I guess we could look at it that way, just on a company by company thing. I mean, Aberdeen, for a small company, Aberdeen did really well. They have ASGI, they have closed-end funds. Usually these one-shot companies are mainly closed-end fund companies, not advisor shares. They have, I forget what their fund's called. I think it's called Vega, VEGA. But look at Amplify. I mean, Amplify is a very respectable showing here. 11 companies, averaging a 22% yield. Had a rough quarter, but they're above the average for the list. They're outperforming the average ETF on here. Now they only have about half the yield of the average ETF on here, but that can be a good thing. I mean, and really, if you have about half the yield, they ought to be doing a little bit better on NAV return. But they've had some ones that, I mean, they're in Baggy and Biddy, and those are just, I mean, it's not Baggy and Biddy's fault that crypto's in a pullback. You don't have to own it when crypto's in a pullback. The average 1-year total return for Amplify is 17%. That's a good 50% premium over, about 50% premium over, the industry-wide average. Their average short-term max factor is a little negative, not too bad. Average stable dex at Amplify is 63. So in the next company we could look at just individually, the next big company is Defiance. And they have 6 companies. Their average rank was 143rd, but their average yield is 76 because, of course, I mean, that's just kind of, they have the higher yielding stuff. but their quarterly NAV return is only -8. It's not -9 like the rest of the industry. So they're actually out. They actually have way higher yield than the industry, and they have slightly better NAV return. Now granted, that's mainly because of USOY that's probably holding this average together. But I mean, because I know that MST is hurting it. But I mean, that's what averages are. You have a few good ones, you have a few bad ones. You kind of see what kind of company you have here or what kind of lineup they have. And their average total return at Defiance is 12.45. That's not too bad. It's better than the industry average. Your StableDex is not very stable, lower than the industry average. Then we have Granite shares. They didn't have anyone in the top half. They got 0 points. Average rank is 224 out of 233. That's not too bad. Granite, I mean, that's not too good Granite shares. Oh, well. Average yield is 169.23. Quarterly NAV returns down 30%. I mean, anyway, it doesn't matter how high your yield is when you're bleeding off NAV like that. I mean, that's going to be way worse than like everyone thinks YieldMax sucks so bad. Well, look at this. Let's go see how bad it sucks compared to that one. I mean, it's not great. I mean, but it's doing better than that. Average yield 62, average NAV return -15. That's a gigantic difference. It's like I always say, Granite shares, saw YieldMax's prospectus and said, "Hold my beer." I like YieldMax and Round Hill, as you guys know, and I like Rex, but they're all just about in the same boat as Risk goes. I don't like all of their stocks. I mean, I'm not a big ULTI fan from Rex. I mean, but I think Round Hill and YieldMax have good ETFs. They're for bull markets, though. All right, yeah. So let's catch up with what you guys are saying. Okay, I'm glad you're in Zenful. I'm glad you are in Discord. It's going good. Cash flow, how are you doing there, bud? You'd like to see by ranking average 1 year total return. Okay, let's do that. Okay. It's the small companies, but of the big companies, it's Curb number 1, Round Hill number 2. Good job, Round Hill. Round Hill's that's what I'm saying. Round Hill's a good company. If they have some good funds. I mean, they do a good job. I like Round Hill. I mean, I sold WPay, but it wasn't Round Hill's fault. I bought WPay and the market went to heck. I mean, I shouldn't have bought WPay. I was trying to put on risk and I put on risk at the wrong time. So my bad on that one. But WPay, I'll get back in WPay when the market goes up and I'm going to be raging. And then Simplify is third on 1 year total return, 20%. And then Rex is fourth at 18%. Amplify is fifth at 17%. And then we go to Defiance. Defiance down here at about a 12.45. Company-wide average or the industry average is 11.8%. Then we have Global X just under that. Then we have, X funds. Then we have Neos under that. Neos doesn't take a lot of risk. So you aren't going to have as many home runs as you do on the ones that take risks, but you're also never going to have a reverse split from Neos. Sometime I need to make a show about variance and explain the concept of variance, but I'm going to do that show sometime. But so Neos and JP Morgan are going to have lower variance. But anyway, and then the rest of them you can see down here. YieldMax is actually negative on 1 year total return. But so remember though, but over the past 3 years, if you go inception to date, they're positive 12%. So what that tells me is they've had a bad year. Because the positive 12% includes, it was up until March 1st. And we haven't dropped that far or it's March 2nd. We haven't dropped that far from March 2nd. The market's down 3 or 4%. I mean, So, but in any event, so that tells me that a bunch of their alpha profits were front loaded, and they haven't been recurring lately. Not on a company-wide basis. Not on a company-wide basis. And Granite's right here. Granite is actually just barely over positive. It's up a half a bit. But yeah, that's a good one here. Hey, Robert, what's up here? GIF looks good. Half cover calls, all the Rex. I know it. Man, Rex is tough. That GIF should be really good. Maybe I'll get WPay. Maybe I'll get GIF instead of WPay in the next market rally. My point is Roundhill, Rex, Yield Max, whatever. The ones that are more risky also have, those are also the ones that hit the home runs when they get it right because they take more risk. I mean, COIW was on top of the max factor for 2 or 3 weeks this summer. It was in the top 20 all summer, and from what I remember, I wasn't keeping records. I wish we could look. That's why I did all this. Just think when I have the same level of data I have here, but I have for every week. And then I have it after 6 months and a year. And we can go back and look at moving averages and stuff of, how the funds are doing over time. We could chart a moving average of the, of any of these things, but I'd say probably a moving average of the 1 year total return would be really good to look at. And a moving average of the average yield would be good to look at. I mean, really, that's all or really yield and NAV return, that's, yield is your gross and NAV return is your net. If you pay a 20% yield, or let's say you pay a 50% yield, but you only make a 10% NAV return, if you took the whole yield, you're going to have capital erosion in your account. You're spending more than you're making. And remember, the ratio on Yield Max, even as well as they did at 12% market performer, even as well as that was over the past 3 years, they've been around longer than a lot of these companies. Over the past 3 years, in hindsight, you wouldn't have known this now up front. We used to always estimate it was 1/3 that you could keep, but for Yield Max, it looks like 1/4. But we can also start measuring the company-wide how much you have to invest ratio with these numbers. But that's the way it's just a good way to think of it. So what I think of the rental house, and you own a rent house, and let's say you own it in cash, but you have insurance and maintenance on it. All right. But you own a rental house and you're leasing it for $2,000 a month. It's a nice, 3-bedroom house somewhere, and it's going, I don't even know if you can get a 3-bedroom. But maybe, I don't know. It depends on where you live. Rent it for $2,000 a month. Okay. You don't have a mortgage. So that's your mailbox money. That's your retirement money. The rent's like yield. You can't pay yourself $2,000 a month because you have taxes, you have insurance, you have upkeep, you have expenses. You might only clear $500 a month. So in this example, the rent houses rent $2,000, that's the yield, but the rent house's NAV return is 5%, it's $500. You guys know what I'm saying. So right there, that tells you, and especially if you measure that over time and you get a good ratio, that tells you out of the rent, you can spend about a quarter of it without going into debt, without ruining your capital and your investment. So I think that works it's that way with any investment. You own a restaurant, and I knew a guy that had a restaurant, and the restaurant sold like $3 million a year or something, but he didn't make $3 million a year. I mean, not even close. He made a good living, but I mean, the $3 million a year is the yield. The NAV return was the, 250,000 or whatever it was that he took home. Amplify. Yes, sir. Check it out. We'll look at Amplify. We can sort this right here. Amplify. So Amplify has 11 funds, 35 points. I mean, they actually did well as far as hitting the top. As far as getting on the board, the points are given for ranking in the top half, and you get more points for ranking higher. So 35 points was the second most points, I think, next to YieldMax. YieldMax dominated the top 40. Yeah, YieldMax had 37 points. And now that's State Street. Actually, State Street was number 2. YieldMax is number 1. State Street was number 2. And then I think Amplify was number 3. Where is YieldMax now? Yeah, YieldMax had 87. They had a lot of people. The ones they do have do really well, like I always say, because they take a lot of risk. So when one of theirs hits it, like a CRCO is really hitting a lick lately. They do well, but they also have the ones that are more prone to reverse split and more prone to other stuff too. So that's the concept of variance. But on Amplify, so they have their average rank is 106. That may be a better way to look at it than the point system. But so YieldMax's average rank is, just for comparison purposes, is 162. Okay, but it's not as bad as Granite Shares at 235 or no, Granite Shares is like, I know you didn't ask about it. I'll go back to Amplify. Granite Shares has probably the worst. Let's look let's finish Amplify, and then let's sort it by average rank. All right, so Amplify, 106. That's respectable average rank. So they're in the top half, because there's 200 and they're in the top half on average, and they have plenty of total points. They're right up there with Aberdeen, BlackRock. They First Trust. All the good companies have a lot of points. Gameco, Global X, Invesco, Innovator. The ones that have double digits are the better performing companies. Curve, Neos, Simplify, Tap Alpha, UBS, Westwood, and YieldMax are kind of the ones on the higher end there. As far as points go, okay, so back to Amplify. Average yield for Amplify is 22. This quarter, though, the NAV return is down 8. But, it's down for most of these, especially the ones that pay the higher yield. But over the past year, just like a lot of them, they've had a good last year, bad quarter, but they're averaging 17% total return a year. So what that tells me right there, these guys, Amplify's average yield is 22. Okay. So that's how much rent they're getting in. They're making $2,200 a month on rent. Okay. Well, their total return is their net. Is their net. So their total return is $1,700. So this is like having a house that brings in $2,200 a month, and you just have about $500 worth of expenses. That's a pretty good. So of this 22% over the past year, you could have spent, in theory, about 70% of it, whatever percentage 22 is of 17 or 17 is of 22. It's about 80%. So about 80% of Amplify's money over this past year was spendable. Whereas on the story I did on YieldMax the other day, only a quarter of the money was spendable. So Amplify is doing better over the past year at giving you spendable money. Anyway, but on to the rest of the list. Amplify, and it's kind of average stability. Amplify's 63% is stable. It's a broad market. Let's do this. Let's rank it by average rank. Now, these companies that have 1 or 2 don't count, but let's see, of the big companies that have at least 6. Number 1 is State Street. Number 2 is Curve. Number 3 is Neos. Number 4 is Amplify. Number 5 is Simplify. Number 6 is Defiance. Number 7 is YieldMax. Number 8 is Rex. Rex is getting brought down by ULTI. Rex isn't as bad as their rankings look. But also they have a lot of tech stuff. Tech's pulling back lately. And then Round Hill comes in number 9, and then Granite will be number 10. Yeah. And that's of the big companies. Average rank is interesting to look at. We've already looked at average yield. I think we've looked at average on all of these things. Yeah, and we just did amplify, so you've already seen that. Okay, so what else do you guys want to look at? Any specific funds you want to look at? Your favorite fund? I'll show you something. Somebody said, hey, you know, they like SLVO. They said, why didn't SLVO make it? And I said, I don't know. I mean, SLVO is a really nice, you know, it's a good performer lately. And it definitely didn't make it. So I checked the database, and SLVO is number, let's rank it by, man, Claude has this messed up again. Darn it, Claude. Well, anyway, long story short, SLVO is good, but its NAV is down this quarter. So it came in like 80th place. There were 79 companies that had better NAV return, because we start with NAV return. NAV return's everything. But there's 70 companies that had either better NAV return or some combination of better risk-adjusted reward or whatever. But SLVO is by no means, just because it doesn't make the top 40, look how good this thing has been. So let's just go for the past quarter, because that's what the short-term max factor measures. January, February, March. Okay, so for the last quarter, no, that's not right. We'll do it like this. All right, so for the last quarter, SLVO started at 100, and now they're at 96. That's not, it's only 4% NAV erosion. And, or I should say, they paid $16 over a quarter. So that's $64 over a year. They're paying at about a 64% rate. Okay. So you have a 64% dividend and a 4% of NAV erosion. That's really no big deal. But the daily factor really takes seriously your safety, you know, and other things being equal, we'd rather have something that pays a 60% yield and has no NAV erosion. You know, maybe is even a little bit safer than this. And they're ones that do it. But even though this was 80th, I would still take this all day long. I mean, the NAV dropped $4. Forget about percentages. The NAV dropped $4, but you got $16 back in dividends. So you created $12 of new money. That's a 12%. There it is right there also. A 12% total return for the quarter. That means this thing is making about 50% a year if this rally, you know, it's on that kind of pace. That's a really incredible looking ETF, but that also goes to show you just how conservative the max factor is. I listen to you guys. Even though I like ones like blocks, and for my own account is different. I have different, you know, risk and reward or whatever, but I certainly don't want to encourage that behavior in other people. So I invented the max factor also for myself, but the invent the max factor to find the safest funds, the ones that have everything. I mean, there's 233 of these nowadays. There's no reason you have to settle for a bad fund, right? I mean, that's my theory anyway. I'm not going to settle. We aren't going to have not one penny of NAV erosion. No, but so here's the way that'll work though, because at some point, if we get into a major market pullback, I guess the inverse funds will probably have positive NAV erosion. We'll have positive NAV if we get into a really down market. But at some point, if the market goes down enough, a lot of these will have negative NAV. But then in that case, it's going to be the ones that have the least negative NAV. But you cannot have a positive max factor and have negative NAV. It just, you know, like I say, I'm just really conscious, regardless of how I act regardless of how I feel inside my brain, I'm trying to make the max factor to be objective and to objectively find the best ETFs out there, the best high yield ETFs there are. So anyway, but we'll keep an eye on this stuff. I think this stuff is interesting. Man, there's 45 of you guys here. I really appreciate that. Oh gosh, I just remembered Not like this matters, but it just makes me mad when I forget to do it. Content. It looks like I picked up some new subscribers just now. I think people are liking this factor stuff also. And the factor's going to get a lot better, but that top 40 show, it's going to get a lot better. And I promise. So tomorrow night, we're going to do the daily factor is different than the max factor. The max factor is the overall list, and that's when we do the top 40 show. The daily factor is just the nightly show where we take a subset from the max factor. One event. Yeah, tomorrow night it's going to be Misty Mafia night, but really Misty, we'll just make it Maximalist Monday. So we'll just throw in all the Misty stuff or Mr. stuff, whatever, all the Coinbase and Hood stuff. Or should we do Coinbase and Hood? Coinbase, I mean, well, maybe not Hood. Hood will go with tech. But probably Misty and Coinbase are fair. We'll throw those in, and then we'll also throw in things like Blocks, BTCI, SEPI, LFGY, those kinds of things. SEPI's been doing really. SEPI's one of the few crypto-based ones that are holding up better than Blocks. But yeah, SEPI's doing a good job. AIPI is doing a good job. I mean, Rex has some good funds. And then what else we have coming up later in the week is I'm going to do the company-wide since inception results for NEOS. And then after NEOS, I think I want to do Roundhill. And then I want to do Granite shares. I've got lots of requests to do Granite shares. And then we'll do the Defiance company-wide. And it'll be the same thing as the high yield derangement syndrome show. I won't keep calling it high yield derangement syndrome. I was just trying to be funny. But it'll be, we'll do a company-wide, deep dive into NEOS next. And look at, and what we're trying to really determine on each company is how much of the dividend on a company-wide basis is actually spendable, where you could spend it without worrying about, depleting the NAV too much. All right. Well, I think that'll be good. I'm really looking forward to all this, and I appreciate you guys being here. If you have any questions, I'd be happy to answer them. If you don't, that's fine too. It is a Sunday night. Let's go look at futures. Remember, it's not financial advice. Consult a licensed planner. Let's see here. Let's get on 30 minutes. I'm going to get out of here and turn it back on 5-minute quotes and go have fun. Or no, actually, I'm not. I have something I'm working on. I need to work on that NEO show. It took me a week to put that Yilmax show together. I may not seem like it, but it took, oh my gosh, there's a lot of work in that. But now that I have a system that I can do it faster, but I'd like to have the NEO show out by maybe Tuesday. And then maybe the Roundhill one. I'd like to get all of these ones done here in the next couple of weeks. NEOS, Roundhill, whatever. All right, let me show you the screen. All right. Well, look at this. On the 30-minute chart, in Qs, we did our typical bear market rally. Look at the bear market rally on Friday. And then just vicious, or that was Thursday. I think that was Thursday, right? Yeah. But anyway, a vicious rally, and then it's bet by sellers. And then what happens? You make a new low, lower highs, lower lows. We've just been in that kind of phase lately. But anyway, we've rallied up to the 50. We'll see. We need to get over the 50 and over the 200. This is just 30 minutes. This isn't on the daily, but the trends work the same way in the shorter time frames also. We need to get over and stay over instead of just going over for a few days like we did earlier in the week, the 9th and 10th, and then peter out and then give up the 200-day and not be able to take it back. We really want the 200. We really want the moving average to be sloping up. Also, it's just been this has just been lousy price action lately. No fun at all. Let's look at ES, which is S&P 500 futures. Same thing. They've reverted back to the 50-period SMA. The key level we're looking at for tomorrow, or one of them, is 66.41. We don't want to see it get outside of the previous day's range, because if it does, then we'll probably go for Sunday's low. And then at some point, there's a monthly low in here too. And if we take out the monthly low, that's not a good sign either for long-term investing, because I'm talking not people that watch daily charts, people that watch longer term charts, not people that get in and out all the time. But when you get a monthly downtrend, that's nasty anyway. But the thing is, I have a rule about the market. When everyone thinks something's going to happen, lots of times it doesn't happen. And I don't know if it's because if everyone thinks it's going to happen, they're ready for it and they're hedged. I mean, that's kind of what I think it is. But but the market always acts in a way to disappoint as many people as possible. I mean, the market's price in options will always, not always, but lots of times, it's called the Max Pain theory. But the Max Pain theory is the market will always try to close wherever it messes up as many retail traders as possible. So I think it's kind of the same theory. So the kinds of crashes that are really bad are when people aren't expecting them and people aren't hedged, like Volmageddon. I mean, where you get caught by surprise, a true black swan. I think maybe people were expecting 2020. I know I sure was, but maybe the general public wasn't. And that one, but when everyone knows something's going to happen, maybe we just kind of grind down like we've done that. It won't keep people from selling, but if people are hedged and are where it's happening, it may be, who knows, but who knows? A lot depends on how soon we get the Straits of Hormuz back open and, what goes on in the war, if it escalates or if it cools down. I mean, I think that'll depend a lot too. So, all right, guys. Well, I'm going to check for any final comments. If there aren't any, I'm going to let you guys get out of here. I appreciate y'all being here. Remember, not financial advice. Consult a licensed financial planner, please. And if you'd like to support the station, you can always do so. My PayPal is on the screen. It is paypal.me/Max Convexity. Don't forget to like and subscribe, and don't forget to have a wonderful Sunday evening. And I will talk to you guys later.